With gold, I mean, gold production has been flat now for 6 years. Even though the gold price has tremendous margin for the industry has not been able to increase production by 1 ounce over the last 6 years. Where's that going to come from? It's going to be a higher price and it's going to feed into more inflation. So I think we're going to see a second cycle of inflation coming in the next 2 to 3 years.
Pierre Lassonde, Chairman Emeritus of Franco-Nevada and CDO of Firelight Investments, predicts that the U.S. will experience a significant recession in 2023, leading to a 30% crash in the stock market. Additionally, Lassonde forecasts that inflation will rise to 10% by 2026. As a result, he is currently focusing his investments in gold and silver. Lassonde shares his thoughts on the gold market in his discussion. In the medium term, he holds the belief that gold might reach $2,200 to $2,400. However, within the next 5 years, it could potentially soar as high as $10,000. According to Lassonde, the Fed's ability to make significant moves is limited. He thinks that if they increase interest rates beyond 1.5%, it will lead to a significant downturn in the economy. Before starting the video, please subscribe to our channel and click on the notification bell to receive more informative content.
I think what's happening right now is that over the past 5 years, both Washington and the Fed have created extremely loose, monetary condition. So they've created a runaway freight train. Now the Fed is trying to put the brakes on the freight train, and they started slow, and now they're seeing that the end of the rail is coming, and then they're really squeezing. And you're seeing the spark starts to fly under the train, the picture of that. Who can afford a 7% mortgage rate? Who can afford a car at 10 or 12% interest rate? So they are going to kill the real estate business, the car business. They are the 2 biggest businesses in the United States. So what do you think is going to happen to the U.S. economy? Yeah, I think you're going to see the U.S. economy enter into a recession in the next 2 quarters, and it's going to be a fairly significant recession. All the earnings are overstated. Not overstated. All the forecasts are overstating the earnings. They're going to come down, and with that, you're going to see the S&P come down by about 30%. Same with the Dow. The Fed will start to, turn it around. They will drop, but they're not going to drop fast enough. And in terms of the rest of the world, I think is going to do a little bit better. And so the dollar is going to come down, and gold is going to start to go up because of that.
In response to a recession, a central bank typically introduces liquidity into the market, causing inflation that reduces the currency's worth. Consequently, investors lose faith in the currency's strength and seek refuge in gold, which typically maintains its value in periods of economic weakness. According to Pierre Lassonde, investor interest in gold as an investment is continuously growing, while the demand for gold and jewelry remains relatively unchanged. Gold functions as a form of insurance, and its price often becomes irrelevant to people who feel they require it. Pierre highlights how gold benefits from a weaker dollar and a low interest rate environment. He argues that real interest rates must stay low to facilitate debt repayment. At present, interest rates are negative, which he believes is positive for gold. When a reserve currency is robust, gold becomes less essential, but when it weakens, gold assumes the role of the anti-dollar.
I would have expected a lower gold price, to be honest with you, because gold doesn't like recessions. Okay, every time the US goes into a recession, the gold price, or the world actually goes into a recession, don't forget that half of the gold is bought, physical gold, is bought by people for jewelry, and that market is your floor. And in a recession, that money disappears. And what saved gold in the last year? Central banks. So these central banks are buying gold as a reserve currency. Will they use gold to back a new currency? We don't know, possibly. Or a basket of currency? We don't know. Will they use a crypto kind of currency backed by the Chinese government? We don't know. What I do believe, though, is that at the end of the day, you will end up with a dual world in terms of system of payment and the currency you pay. And that's not good for the dollar. That is not good for the dollar. What's going to happen to the dollar? It's going to go down. How much? Don't know. But to my mind, over the next 5 years, you will see $2,300, $2,400 gold because of that.
Here, Pierre suggests that we will witness a pattern similar to the past 4 years, with inflation, interest rates, the dollar, and gold all increasing annually. Therefore, we can expect the same trend to persist for the next 4 years. The escalating geopolitical tensions have resulted in an upward trend for gold as a safe haven asset. Investors can gain exposure to the yellow metal.
When you look at the indices, like the gold indices, for example, it's been flat for 10 years. So, reflecting the total disinterest of generalists in particular for the industry. Why it's so? Several answers. One, I believe, is that particularly if you're an American, the Dow or the S&P, there is this conception that there is a Fed put, that every time that the economy is going to kind of like start to fall apart, that the Fed will just cut interest rate and everything will be good again. So that, I think, has been one of the main factors where why do you need to invest in gold? Because the dollar is strong. When the dollar is strong, you don't need gold, and you just ignore the entire sector. What's going to change, to my mind, is that I think that the S&P is overvalued by 30%. I think that in the next, 6 months, you're going to see the S&P and the Dow go down by 30%, and yet the gold equities are not going to do that because they carry dividend yield that are going to keep them there. Because at $1,850 gold and at $4 copper, the industry is doing quite well. Thank you very much. The faith of all reserve currency is to go down, simply because of balance of payment. But in terms of the US dollar, it will mean a lower dollar vis-a-vis a basket of currency, a much lower dollar. You're going to see dollar being repatriated. It means inflation.
Yeah.
That's what it means. And there's nothing the Fed can do about it. They can raise interest rate. There's nothing you can do about it.
Increased utilization of gold in the global monetary system could lead to noteworthy effects on the amount of physically available supply and, in turn, prices. Central banks, following their unprecedented gold purchases in 2022, are persisting in their efforts to build up their reserves in 2023. This concludes our discussion for today. Do you agree or disagree? And what are the reasons for your stance? We encourage you to share your thoughts in the comment section below. If you found this video informative, please give it a thumbs up. Don't forget to subscribe to our channel to stay informed on the latest news and videos. Thank you, and we'll see you in the next one.